Here's something I see all the time. People start collecting Social Security and assume it's tax-free. Then tax season rolls around and they're shocked to find out that a good portion of their benefit is being taxed. And they ask, why didn't anyone tell me this? The truth is, Social Security taxation isn't simple, and it doesn't work like most other types of income. Depending on your total income, up to 85% of your benefit could be taxed at the federal level. And in some states, you could owe state tax on it too. But here's the kicker. If you understand how the system works, you may be able to take steps to reduce the amount of tax you pay on your benefit. And that can make a big difference in how much you keep throughout retirement. Hi, I'm David Hike, financial advisor at DMH Financial Solutions. I help retirees and pre-retirees across the U.S. build tax-efficient income strategies so they can retire with confidence and clarity. And in this video, we're going to break down how Social Security is taxed, how to estimate your own tax exposure, and what steps you can take to help keep more of your benefit working for you. Let's walk through it together. Part 1. What makes Social Security taxable? Let's clear up a big misconception. A lot of people assume that once they retire and start collecting Social Security, that money is completely tax-free. But the truth is, for many people, it's not. In fact, depending on your overall income, up to 85% of your Social Security benefit can be included in your taxable income at the federal level. So how does that happen? Let's walk through it. First, it's important to know that Social Security is not taxed the same way as income from a job, IRA, or pension. When you're working, 100% of your wages are typically subject to federal income tax, state income tax, and FICA taxes, the payroll taxes that fund Social Security and Medicare. But when you're retired and receiving Social Security benefits, things work a little differently. You're no longer paying FICA taxes on those benefits, and only a portion of the benefit may be taxable at the federal level, depending on your overall income. Some states tax it, but most don't, and we'll come back to that later. Now, here's where things can get confusing. The IRS doesn't just look at your Social Security in a vacuum. They look at your total income, which includes withdrawals from retirement accounts, dividends, rental income, even interest on tax-exempt municipal bonds. They add all of that up using a specific formula called provisional income. And based on that number, they determine what portion of your Social Security benefit will be included in your taxable income. It works like a tiered system. Let me give you the general rules. If your income is relatively low, your benefit may not be taxed at all. But as your income goes up, even by a few $1,000s, you can quickly go from 0% tax to 50% tax, and eventually to 85% of your benefit being taxable. Now again, that doesn't mean you pay an 85% tax. It just means 85% of your Social Security is added to your other income and taxed at your normal federal income tax rate. For example, let's say your Social Security benefit is $30,000 per year and you fall into the 12% federal tax bracket. If 85% of that $30,000 is taxable, that means $25,500 gets added to your taxable income, and 12% of that is roughly $3,000 in tax. So you keep the other $27,000 or so of your benefit. It's not terrible, but it's still more than many people expect. And the tricky part is the tax exposure can go up over time, especially if you're also drawing from IRAs, pensions, or brokerage accounts. That's why understanding what causes Social Security to be taxed and how to plan around it can help you keep more of your benefit. And to do that, we need to understand provisional income, which we'll break down in the next section. Part 2, what is provisional income? So how does the IRS decide how much of your Social Security benefit gets taxed? It all comes down to something called provisional income. Now, I'll be honest, this is one of the most confusing parts of how Social Security works. But once you understand the basic formula, it becomes a lot easier to plan around. So here's how provisional income is calculated. 1. Start with your adjusted gross income, excluding Social Security. This includes things like IRA or 401k withdrawals, pension income, dividends and interest, capital gains, rental income. 2. Add in any tax-exempt interest. That's right, even municipal bond interest, which is normally tax-exempt, gets counted here. 3. Add in half of your Social Security benefits. That's your provisional income. Let me show you a simple example. Let's say you're married and your income in retirement looks like this: $40,000 in IRA withdrawals, $10,000 in tax-exempt municipal bond interest, $30,000 in combined Social Security benefits. Here's how we calculate provisional income. $40,000 from your IRA, $10,000 tax-free interest, $15,000, which is half of the $30,000 Social Security, equals $65,000 of provisional income. Now that we have that number, we can use to determine how much of your Social Security benefit gets taxed. This is what triggers the tiered system we talked about earlier. So if your provisional income is over certain thresholds, and we'll go over those in a second, you'll see up to 85% of your Social Security included in your taxable income. Let's do a quick side note here. A lot of people assume that things like Roth IRA withdrawals don't count towards this calculation, and that's true. Withdrawals from a Roth IRA do not count as provisional income. That's one reason why Roth planning can be so powerful in retirement. But for now, just remember this: the more income you generate outside of Social Security, the more of your benefit is likely to be taxed. And as we'll see in the next part, the IRS has set very specific thresholds that determine where you fall on that 0%, 50%, or 85% scale. Let's walk through those in part 3, federal tax thresholds. Now that we've calculated your provisional income, the next step is figuring out how much of your Social Security benefit is actually taxable. This is where the IRS uses a tiered threshold system based on your filing status, whether you're filing single or filing jointly. Let's walk through each one. If you're filing as a single, provisional income under $25,000, none of your Social Security benefit is taxable. Provisional income between $25,000 and $34,000, up to 50% of your benefit is taxable. And provisional income over $34,000, up to 85% of your benefit is taxable. Now, if you're filing jointly and married, provisional income under $32,000, none of your Social Security is taxable. Provisional income between $32,000 and $44,000, up to 50% is taxable. And provisional income over $44,000, up to 85% of your benefit is taxable. Part 4. What about state taxes? So we've covered how Social Security is taxed at the federal level, but what about the state you live in? Here's the good news. Most states do not tax Social Security at all. In fact, as of now, 39 states plus Washington, D.C. fully exclude Social Security benefits from state income tax. That means for the majority of Americans, you only need to worry about federal taxation. But there are still a handful of states, currently 11, that do tax Social Security to some degree. Part 5. Key takeaways and planning insights. Now that you understand how Social Security is taxed, both at the federal level and in some states, let's zoom out and talk about strategy, because the goal here isn't just to understand the rules, it's to use that knowledge to make smarter decisions and keep more of your benefit. 1. Not all of your Social Security is taxed. Even if you're in the highest income tier, only up to 85% of your benefit is included in your taxable income, never 100%. That means Social Security is still one of the more tax-efficient income sources in retirement. 2. Social Security taxation is based on other income. The more income you take from IRAs, pensions, dividends, capital gains, even tax-exempt bonds, the more of your Social Security may be taxed. That's why income coordination matters. It's not just about what you earn, it's about what kind of income you take and when. 3. Roth accounts can be a powerful tool. Here's an often overlooked planning opportunity. Withdrawals from Roth IRAs are not counted in provisional income. That means you can take money from a Roth without triggering more tax on your Social Security benefit. That's one reason I often help clients build tax-diversified portfolios, a mix of pre-tax, Roth, and taxable assets, so we have more flexibility when it comes to managing taxes in retirement. 4. Provisional income thresholds don't adjust for inflation. That's what's frustrating but important. The $25,000 and $32,000 income thresholds for taxing Social Security haven't changed in decades. They're not indexed for inflation. So over time, more and more retirees are seeing a larger portion of their benefits taxed, even if their lifestyle hasn't changed. That means the tax planning you do today could matter even more in the future. 5. State taxes might not be a big factor, but it depends. Most states don't tax Social Security, and even those that do often offer deductions or credits that reduce the burden. Still, if you're considering relocating, or if you're right on the edge of a taxable threshold, it's worth reviewing the details for your specific state. Knowing how Social Security is taxed is step 1. Step 2 is designing a retirement plan that works around it. And that's where working with a financial professional can make a real difference. If you're approaching retirement and want to make sure your income plan is structured to minimize taxes, not just this year, but over the next 20 or 30, let's talk talk. Click the link in the description to book a consultation with me. We'll walk through your income sources, evaluate your Social Security strategy, and help you build a retirement plan that keeps more of your money working for you. Thanks for watching, and I'll see you in the next video.